We know from a wealth of academic and stock market returns data going back to the 1920s that the probability of a positive return from stocks increases over time. In other words, the more patient you are and the longer you hold it, the greater chances are that a diversified portfolio will come out ahead in terms of meeting your individual financial goals. Michael Humbert, an investment strategist at Dimensional Fund Advisors, has studied such research. As DFA research has found in looking at stock market returns over extended periods, the U.S. stock market has increased investment wealth during a vast majority of one-year periods, and that's going back to 1926. Researchers at Dimensional have also found that a similar pattern emerges when looking at 10-year returns for U.S. stocks. Hi, Michael. Thanks for taking the time today to talk to us about this.
I'm happy to be here. Thank you, Murray.
Dimensional's research has found that whether you're looking at shorter or longer term periods, the odds keep improving in your favor, the greater the level of discipline maintained, correct?
That's right, Murray. The probability of a positive return from stocks, it increases over time, which makes sense. People, they wouldn't invest without the expectation of a positive return. But let's look a little bit more closely, starting with that shorter horizon that you referred to. An investment in U.S. stock market, it grew wealth about 75% of those one-year periods going all the way back to 1926. Now, let's shift our focus towards that longer term. Over 10-year periods, this improved, occurring about 95% of the time. And while positive stock returns are never guaranteed over any horizon, when I look over longer, how long do I have to find until there's no negative return? It's about just over 15 years, 184 months over that period. If you could hold on for 184 months, you didn't see a negative return in the U.S.
Yeah, and as we've covered in the past, studies by Dalbar have consistently shown that most fund investors suffer lower returns by trying to time markets. Morningstar, they have a Mind the Gap study, and it also looks at the ill effects of taking a tactical as opposed to a strategic view of portfolio management. In their latest reports, both have shown big differences between what the average investor has earned over time on an annualized basis by buying and holding a diversified portfolio of stocks and bonds versus trying to time markets.
Tactical allocation, trying to beat the market by outguessing it, is a very difficult, if not impossible, proposition. We have our own study of active managers who outperforms historically, and then do they continue to outperform in the future? We don't see any trend, well less than a coin flip. It's incredibly difficult to outguess market prices because market prices, they're updating in real time, reflecting our aggregate expectations for the future. They're our best information processing model that we have invented as a society. The task of beating a market price is an incredibly difficult proposition.
Yeah, it's interesting. In Morningstar studies, they show that holding a globally diversified portfolio of stock and bond funds and using a glide path, they categorize it as allocation funds. And those are basically diversified funds that use some sort of a glide path or some sort of strategic resetting of the allocations between stocks and bonds on a regular basis. They typically do the best. And I know at IFA, our wealth advisors are real big proponents of using our IFA glide paths to kind of address those sort of allocation issues.
Absolutely. So the allocation between your mix between stocks and bonds over your life as your total capital, your financial capital, and your human capital, as that mix changes, your allocation to stocks and bonds should change as you approach your goals, right? We save and invest with the purpose of achieving a goal as the shape of our capital changes over time. As when we're older and maybe less able to use our human capital, we rely more on our financial capital. So a glide path is a natural and great tool tool to achieve that goal. Very different than a tactical allocator who looks at returns and current environment and mixes within their equities or within their fixed income sleeves to try and beat a market there. A little bit different because we're losing focus in that effort towards our long-term goals.
Certainly. Thank you, Michael.
Thank you, Murray.